My name's Taylor Honrath. I'm the Chief Operating Officer at CleanTech OC, and we appreciate you joining us this morning for our third annual conference and expo. I want to thank our board first and foremost. They make this possible. Many of them have been involved since day one, and without their vision and their leadership, we wouldn't have this great program today, and we all would not be here. I also want to thank our members. We've almost hit a milestone of 100 member companies, and we're really excited about the growth we're seeing here in Orange County, and delighted that all of you want to be a part of it. Also want to say a special thank you to our exhibitors. This is probably the best year we've had so far with the exhibit hall, and if you haven't had a chance to check it out yet, we have a couple dedicated breaks in the agenda, and I really encourage you to check it out. We've got some great companies here. They're all local, and they'd love to have your support, and I'm sure meet each of you. And last but not least, I want to take a quick moment to thank our conference sponsors who certainly make all of this possible, and we're delighted to have their support, and that includes the County of Orange, OC Waste and Recycling, Kenobi Martins, Devon and Devon, SoCal Gas, PWC, the Anaheim Chamber, Chubb, Gannett Fleming, the Irvine Chamber, Eco Solargy, Ernst & Young, the Toronto Stock Exchange, Haskell & White, and the OC Metro. We appreciate you joining us this morning. Thanks for supporting the clean tech industry and being part of it. There's some great things going on here. And without further ado, I'd like to introduce our chairman and president, Mr. Greg Tremarch.
Good morning, everyone, and again, thanks for being here. As Taylor said, I'm Greg Tremarch. My day job is I'm a shareholder at Greenwood Prara, where I practice energy and environmental law, and I'm one of the co-founders of CleanTech OC. We're delighted to have you all here today. This is certainly an interesting time for the clean tech industry. I read an article a few months ago, the title of which was "Clean Tech is Dead, Long Live Clean Tech." I assume the author was a fan of the band The Who, because I'm pretty sure he pirated those lines from one of their songs. But the comment is a very interesting one. I don't think there's any question that the clean tech brand, if you will, has become a bit tarnished this year, and in the last year or two, really, with regard to the Solyndra scandal that I'll talk a little bit more about a little bit. But also just in terms of performance. The point of the article, Clean Tech is Dead, Long Live Clean Tech, was that the investment community has started, or many in the investment community has started looking at clean tech as a negative rather than a positive. And so some of the investment firms are no longer touting their focus on clean tech. They may still be making investments in clean tech, but they're no longer necessarily touting themselves as clean tech investment firms. In terms of where the rubber meets the road, what really we're seeing is that a lot of the generalist venture capital firms have in fact moved away from clean tech investment to some extent. And in terms of institutional investors, I think what we've seen over the last couple of years is, number one, the big pension funds and other institutional investors, I think as a whole, have sort of scaled back on their investment in the alternative asset class as a whole, and certainly scaled back in the clean tech area. So the clean tech sector certainly continues to face financial challenges, and anybody who's with a startup clean tech company right now knows about that. This is a hard time to raise money for clean tech startups. Even the venture capital firms that are still active in the clean tech sector are increasingly reluctant to get involved in early stage R&D plays and stuff like that. So financial hurdles remain significant for us here in the clean tech world. Similarly, obviously, political hurdles. As I mentioned earlier, the Solyndra fiasco, as I like to refer to it, has had pretty substantial ripple effects. And certainly the fact that we're in an election year also plays a big role. But I think most of us would have to agree that the policy of the United States on renewable energy and clean technology right now is a bit murky. Some would say it's in shambles. Certainly we're seeing a lot of the major programs curtailed. I mean, the DOE loan guarantee program and the grants and the tax credits and everything else, they're either being scaled back or eliminated or put into to great question. And also I'll talk about in a moment. That's obviously having a lot of effects on folks in this sector. Technical hurdles continue. Continuing challenges in battery technology and energy storage, and the efficiency issues that continue to challenge the solar and the wind industries haven't gone away, and those remain very significant hurdles for us to clear. And of course, competitive hurdles. It remains very difficult for manufacturers of any kind to compete here in the United States against China and other global competitors, and that is even more the case here in California, obviously, where taxes and regulatory burdens are extremely high. So what can we say about CleanTech as a whole here in 2012? Well, first of all, it's become ever more clear that we really don't have a clean tech industry. What we have is a clean tech sector with a whole bunch of different verticals. And those verticals, some of them have a lot of interaction with each other, some of them don't have much interaction at all, and they are obviously experiencing very, very different levels of success in the last couple of years. So as I think I probably said at our last big program, the CleanTech Investment Forum several months ago, I think that you still can continue to refer to the CleanTech sector today as really a study in the good, the bad, and the ugly. So let's talk a little bit about each of those. The good, there's really a lot of good. For one thing, in 2011, the United States retook the lead over China in total private clean energy financing and investment. There was a record $263 billion invested globally in private clean energy financing and investment. $263 billion. And of that, the U.S. invested $48 billion, China $45.5 billion. So we retook the lead over China in private clean energy financing last year. And as I said a moment ago, some of the verticals are just doing very, very well. Smart grid, energy efficiency, energy storage continue to perform well and offer, from an investment standpoint, some very attractive opportunities for growth and profitable exits this year and beyond. We've got a panel on smart grid later, so I don't want to spend too much time on that. But utilities in the U.S. and abroad are experiencing a revolution, really a long overdue upgrade of the electrical grid that employs hardware, software, communications technology to create what we're calling the smart grid. And the smart grid basically is just an electrical grid that can monitor, predict, and intelligently respond to fluctuating conditions caused by varying behaviors by power consumers and power producers. Smart grid is big, big business. Total investment required for full worldwide smart grid implementation is now estimated at $2 trillion. So to get us from point A to point B globally is $2 trillion. Utilities are already making enormous investments in smart grid infrastructure. There were $8 billion in projects pending in 2011. The first step for many, as a lot of you know, are smart meters. Smart meter industry is enormous. It's projected at a $3.9 billion global industry by 2015 with 250 million smart meters installed. I mentioned a moment ago, energy management is also a very, very successful vertical right now. The building energy management systems business, which includes software, hardware, and services for building energy management, now generates about $1 billion a year in annual revenues, and that's expected to go up to $2.4 billion by 2016. The energy management software sector alone attracted over $1 billion in venture capital, with 42% going to energy management software companies in California. So energy management software is a huge business, and it's huge particularly here in California. Similarly, energy storage. Global venture capital investment in energy storage technology continued to boom in 2011 with $1.2 billion flowing into that sector, which is a 10% increase over 2010. So from a standpoint of the verticals that are doing great right now, energy management, energy efficiency, smart grid technology, those are all booming. There's other good news too. In June, Tesla Motors started delivering its Model S luxury sedan, EPA certified range of 265 miles on an 85 kilowatt hour battery pack. And as many of you know, DoD announced that it will deploy 3 gigawatts of renewable energy by 2025, which will be 25% of its global energy consumption. That's obviously going to give a big boost to the renewable energy development industry. And let's talk about that for a moment as we get into the bad. One good example of the bad is solar module and wind turbine manufacturers. They have just been getting killed in the last year or two. China's CleanTech, which is the world's largest producer of solar panels, lost over $1 billion in 2011. Similarly, Arizona-based First Solar lost almost $40 million in 2011, and that's versus profits of over $664 million in 2010. So First Solar went from making $664 million to losing $40 million from 2010 to 2011. Similarly, as a lot of you probably know, Denmark's Vestas, the world's largest turbine manufacturer, lost $220 million in 2011. That's due largely to these changing governmental policies that I mentioned a moment ago. Not only is the U.S. policy in flux, with the production tax credit programs either being phased out or in question, and many of the other incentives and incentive programs here in the U.S. being curtailed or phased out entirely. It's similar in Europe. The feed-in tariffs in Europe that played such a big role are also being dramatically scaled back, and that has just hammered the solar module manufacturers and the wind turbine manufacturers both here and globally. Similarly, it's created a lot of turmoil for project developers. The phase-out of production tax credit has just thumped the wind project developers that I was doing business with, and a lot of the solar developers are similarly struggling right now. And it's not only the shrinking subsidies and the changing governmental policies. We've now got this whole issue of fracking and natural gas. Fracking, that's the extraction of natural gas from shale formations by the injection of high-pressure water and other materials. It's revolutionized the gas industry in the United States. We, here in the U.S., now produce 3 billion cubic feet more natural gas every day than we consume. A $3 billion cubic foot surplus of natural gas every day. Not surprisingly, prices have plummeted about 50% in the past year. Historically, crude oil has been about 10 times more expensive than natural gas. Today, it's 35 times more expensive. There's a major political battle looming, obviously. The environmentalists are challenging the methods that are being used to get the natural gas out of the shale formation, so that story is still being written. And of course, there are some potential benefits as well. I've heard quite a few experts in the field talk about the potential for co-locating natural gas facilities with renewable energy facilities to help smooth out the flow of the electricity and deal with some of those problems that have plagued the renewable energy industry here in the U.S. Finally, on the bad, the trade war. The U.S. Department of Commerce hit Chinese solar module and wind tower manufacturers with huge tariffs this year. Now that may benefit the equipment manufacturers here in the U.S., but it certainly isn't helping consumers and project developers. So finally, the ugly. Again, what I like to refer to as the Solyndra fiasco. Solyndra's final liquidation plan now estimates that the government will recover just $24 million of the $527 million in taxpayer money loaned to Solyndra. As you probably all know, more than 1,000 people lost their jobs there at Solyndra. A congressional report came out in August, basically concluded that political pressure by the White House, eager to tout its stimulus agenda, fast-tracked the Solyndra loan guarantee despite red flags. Unfortunately, Solyndra is not alone. Abound Solar, Beacon Power, A123 Battery have suffered similar fates, and this is creating major political ripple effects here in the United States. Again, particularly in the election year, the House passed an act called the No More Solyndras Act a few months ago that would wind down any, great title, right? And that statute would wind down any further DOE loan guarantee and restrict the restructuring of existing loan guarantees. Don't worry, I don't see the Democratic Senate passing that anytime soon. There's the criticism of the program. Let's talk about the response. In, I think, June or July, former executive director of the DOE loan program, Jonathan Silver, testified to Congress, and he basically gave these comments. The DOE loans to failed companies represented less than 3% of the total loan portfolio. Congress understood that there were risks and that there would be failures when it appropriated almost $10 billion to cover the potential losses to the program. And in fact, as of today, the total losses under the program are now estimated at less than $3 billion. In other words, only 30% of the $10 billion that was appropriated to cover the losses. As Jonathan Silver stated, because of the multiplier effects, DOE-funded projects created hundreds of thousands of jobs. Well, now we all know it's very difficult to quantify that, so that's come under some criticism. But here's another interesting point that he made, and that is that the energy industry is characterized by heavy capital requirements, illiquidity, and bounded returns. We all know that. That results in the creation of platform companies capable of competing in the industry. And if you miss the opportunity to create these platform companies, you don't get a second chance. Now, that's an interesting argument, and I've heard the argument made in the other direction, that one of the things that's great about the renewable energy is that you don't need the same amount of capital, and you don't necessarily lose the opportunity to create these platform companies. So I think the story is still being written there, but I think it's certainly worth, as we hammer the DOE and we laugh about or cry about the Solyndra situation, I think it's important to understand some of these comments that Mr. Silver made in defense of the program, and I think many of them are very legitimate defenses. Well, in any event, I think certainly Solyndra and the other failures in the DOE loan program certainly doesn't mean the federal government should stop supporting renewable energy and clean technology. The question is, was that the best way to do it? And again, I think that remains to be seen, and from a political standpoint, we're certainly going to be battling the heck out of that issue over the next few years. But there's no question that the utility industry and the energy industry underinvests in R&D. According to a report by the American Energy Innovation Council, the utility sector spends just 0.1% of its revenue on R&D, and the industry average in the U.S. is 3.5%, so 35 times more than the utility industry invests in R&D. The last comment I'll make, and I think I've made this before at CleanTech OC programs, is there was a very interesting article I read a couple of years ago that argued that the problem really in the United States is that the current system of clean energy subsidization is rigged to favor the deployment of only the least risky and most mature clean energy technologies, and that instead we should focus on investing in innovative technologies that have a better chance of competing on even footing with conventional energy sources. That certainly makes sense to me, and of course that challenge is even greater now with the price of natural gas falling as it is. But in any event, both the public and private sectors have to continue pushing for clean technology that stands on its own 2 feet. Ultimately, that's where we have to get. We've got to get to the point where we can compete with the fossil fuel industry on equal footing. So with that, I want to make just one last announcement. Many of you probably have heard already, but we actually succeeded, and when I say we, I mean CleanTech OC, the City of Irvine, and a number of other very committed folks and organizations, in getting the Department of Energy to move its solar decathlon from the mall in Washington, D.C. to the Great Park here in Irvine. So next year, in the fall of 2013, we will have the DOE solar decathlon right here at the Great Park in Irvine, and according to my friend Fred Smoller, who was very instrumental in making all this happen, in fact, the DOE has now told us that they're probably going to let the program remain here. So it'll be here in 2013. It sounds like it's going to be here in 2015, and hopefully this will just become the permanent home for the solar decathlon. Needless to say, that will pretty much be the icing on the cake of putting Orange County on the map as a major player in the renewable energy and clean tech world. And of course, there's a lot of that going on already with the great research that's being done at UCI and some of the leading companies based here in Orange County, Fisker and Quantum and Phoenix and some of the others, Flex Energy. We really have a lot of great momentum here in Orange County, and I'm just delighted to see you all here today, and I hope you enjoy the program. I am delighted to be part of this program today. It's really, I hope you're going to find it to be the best one we've ever put on. So without any further delay, I'm going to go ahead and ask the first panel to come up on stage, and I've got the pleasure of introducing Shiraz Haji, the president of CleanTech Group, who has come down from Northern California to moderate the first panel today. So again, thank you all for being here, and please join me in welcoming our first panel today.
Shiraz. Brian Kramer. Nice to meet you.
All right. Good morning, everybody. Oh, maybe we'll try that again. Good morning, everybody. All right. That's better. Much better. My name is Shiraz Haji, and Greg, thank you for that warm intro and great landscape overview of some of the challenges. I think I'm gonna ask my panelists to keep it a little bit more upbeat here. We need to get some positive energy going in this day, and we do appreciate some of the challenges. But I think we'll start off the discussion with some of the big kind of drivers of why maybe some of us are doing the jobs we are. First of all, just, Greg, Taylor, congratulations on all the progress you've done at CleanTech OC, and everybody who's worked hard. We see what's happening here as being quite special and quite important in the space. My company, the CleanTech Group, provides market intelligence in the space, covering innovations. We've got about 20,000 or so companies in our database, and we sell that to investors, big companies globally. We also convene events, and we also do advisory work, mostly for big corporates. So I think I'll ask each of these gentlemen to introduce themselves and maybe say a word or two as part of their introductions around the drivers. And please make it as personal as you care to when you say, Shaheen, why did you do what you do? Was this something you decided at school or afterwards? But I can't help myself but to feel like it's a little bit of a reminder of some of the macro drivers of sustainability and environmental innovation are appropriate. But please do kick us off with an intro first.
Sure. So my name is Shaheen. I'm with Lux Capital. We're a venture capital firm. We've invested in a little over 25 companies, over 3 funds since 2000. What we do is build and invest in companies that are leveraging breakthroughs in the sciences that relate to energy, healthcare, and IT. We're based in New York. I live and work out of California with one of my partners up in Northern California. We do everything from $500,000 to get a company off the ground, where we serve as the initial operators to license the technology and build up a business plan and help lead a Series A round, up to $5 or $6 million to lead any given investment round. We're opportunistic as to when we get in, whether it's starting from scratch, revenue generating, even corporate spinouts, to make sure we get the biggest inflection on our invested capital. So we're currently investing from a $200 million fund, which we just closed late last year. We've already made 6 investments over the past 6 months. We're very excited about energy. To Shiraz's question, why did I get into venture? I love building new technologies. I love building new companies. I started off as a computer science major at Berkeley, writing enterprise software for hospitals. I got sick of sitting in a cube. I wanted to go out there and talk to entrepreneurs, help start companies, help build companies. I then went on to the hardware side and wanted to get my hands dirty, went to GM, did some power electronics work. I was always a car enthusiast since I was a kid, but wasn't crazy about working for the car business, wasn't crazy about living in Detroit. So I came back to California, thought about going to graduate school, went to UCLA, and during the course of my PhD, I got to know some venture capitalists here in California. I got to know Lux, obviously, when I was doing a postdoc. In between, I started a company in the healthcare monitoring space. Just understanding, I was first thinking about becoming an academic, but then after learning about what VCs do, how we bring new technologies to market, how we enable new technology, and how we make it impact everybody's lives, the thought of becoming a VC became a lot more attractive for me personally than being an academic, and that's what ended up being my career path. So I joined Lux in 06 as a consultant while I was postdocing, and then I joined full-time in 07. I've led 2 of our investments. Both were primarily on the IT side. I sit on on the boards of one of our energy companies up in Northern California. It's in the natural gas space, and I'm really excited about new energy technologies and helping change the world. So
Great, Michael.
Good morning. My name is Michael Moore. I'm with TMX Equicom Investor Relations, but today I'm wearing the Toronto Stock Exchange TSX Venture hat. And the TSX is a big supporter of clean tech space, one of the largest set of clean tech listings in the world. when you think about what Canadians invest in bank, they, to a large degree, invest in oil and gas and mining. So what is that? That's power and materials. And when you look at CleanTech sector, to a large degree, that's a lot of power and a lot of materials. So it's a very natural transition for those investors. And yeah, sorry. So the power and materials are a very natural element for the Canadian investors and bankers to look at. Why I have got into what I do on the investor relations side, to your point, to make it a little bit more personal, is that I've always enjoyed working with those young companies from the startup stage through and past IPO, helping them learn about themselves and learn about the capital markets, both private and the public, and to help them transition through that. There's nothing worse than to see some of these great technologies and ideas out there not make it as far as they can go because they didn't have the right relationships or they weren't able to tell their story properly. So I really enjoy that aspect of what we do.
Great. Brian, please give us a bit of an intro and any thoughts you have on these macro drivers to this space.
Yeah, so I got involved in, I work at Roth Capital Partners. We're an investment bank in Newport Beach that covers a variety of industry verticals. I joined 5 years ago to kick off the CleanTech vertical for Roth Capital. I got started in CleanTech about 2 years prior to that with a boutique investment bank, I'll call it, in New York that did nothing but CleanTech. So I was pretty fortunate. My background is in energy. I'm an engineer by training. I went to the Department of Energy, was very fortunate to go there, so I'm happy to talk to folks about the big government, but I had a very, very positive experience working at the Department of Energy and then actually for an international organization after DOE as well as NASA. So, I got to see a lot of money spent on projects, activities that really ultimately may have led to nothing. And yet, we have Teflon, we have all these things that have come out of NASA, that have come out of work that the Department of Energy has done at Lawrence Livermore, at Oregon National Lab, at all the national laboratories. So, great perspective on R&D. We did a lot of programs supporting early stage kind of project work at the Department of Energy. Decided wanted to get into finance, was fortunate enough to leverage my energy background to go to this boutique, very small investment bank that focused on CleanTech. There's two different types of folks. I was never one to lay out my 20-year strategic plan and follow it. Was fortunate enough to kind of fall into one really interesting job after the next. I didn't target CleanTech. I was never an environmentalist growing up by any means. I certainly was a recycler trying to do all the right things. So kind of happened upon CleanTech, fortunately. And just been, again, fortunate that whether it's a DOE, NASA, now what I do in CleanTech, I feel extremely lucky to, every night I put my head on the pillow, I feel like I'm contributing to some greater good. Lots of investment bankers out there raising capital for T-shirt companies and restaurants, and that's great, and we need all those things in the next Google and the next Facebook. But to be able to be helping small companies like a lot of those represented here today, both, we focus mostly on public companies, but also work with a lot of private companies. It's just a great place to be. I think macro-wise, Greg touched on it. This is, and I'm sure we'll get into it more deeply, but at a very high level, this is an industry with many verticals. Some are more mature than others. It'll be around for the next 50 years. Some of those large verticals will grow up and go off on their own and be a standalone vertical, come out of that kind of CleanTech umbrella, I believe. But, my simple thesis on CleanTech is, those technologies, processes that, impact allow us to better utilize, dwindling natural resources around the globe. It's that simple, and that problem's not changing, whether it's water, food, materials, copper. There's just limited resources and a growing population and growing middle class. So, again, we're in a down cycle right now with CleanTech. We've been through this before. Will we ever go back to the go-go days? I'm not sure. I don't know that I'd bet against it, but yeah, we'll come back out. And as Greg said, there's some sectors within CleanTech that are doing quite well right now. So
Yeah.
with that, I know we'll dive into some of those more.
Great.
detail.
We too define it as all about resource productivity. 7 billion going to 10, and everybody, as you know, India, China gets wealthier. Everybody wants to consume, cars, meat, and other things, and that drives energy demand that just doesn't add up. So when you think about that, and you think about that long-term driver, maybe let's go to this world of clean tech and sectors. And Shaheen, we heard Greg say, reference the article, clean tech is dead, long live clean tech. There are confusing signs, right? There's massive deployments of downstream solar in some areas, and there are companies struggling in other areas. So maybe let's start with the companies. Where are companies doing well within clean tech? Or are there interesting opportunities that you've thought about? And then we'll come back and also talk about the financing landscape. Let's just talk about sectors and companies first.
Sure. So maybe I can talk a little bit about our approach to clean tech or energy investing. So back in 2006, we kind of looked at the energy and the clean tech space, and we saw a lot of money going after solar, a lot of money going after biofuels, a lot of money going after wind. And we decided to take a variant approach to clean tech investing or energy investing. We looked at areas where VCs and other investors were not looking. We looked at nuclear and how nuclear accounts for a good portion of our baseline energy consumption. There was some activity going on the nuclear reactor side. There's a couple companies, actually there's one here in Orange County that's trying to develop new nuclear reactors. We looked at our investment timeline and we figured that probably won't be something for us, given the fact that these things take probably decades to get approved. We then looked at the waste. And then if you look at nuclear waste, whether there is new nuclear plants being built, there will be more waste. If there are nuclear plants being decommissioned, there will be waste. And everything stays the status quo, there will be, of course, plenty of waste to take care of. And it turns out that the DOE's biggest budget line item, is basically moving around nuclear waste amongst different sites. So we brought on a few very, very talented people in the nuclear industry after talking to probably dozens of people in the space. And we built a company called Curion, spelled with a K, put in a few $1 million, took 40% ownership of the company, and brought in a couple other like-minded investors, while most of Sand Hill was, again, going after solar, biofuels, and wind. And we were able to identify several key technologies around separating waste from water and basically putting it into a permanent form as glass, or vitrifying that waste. And we built Curion, and Fukushima hits. The CEO gets a letter from TEPCO saying that, hey, we'd like you to come out here and check out what we're trying to deal with. And he came back after 5 weeks with a $100 million contract with TEPCO to basically decontaminate the water that had flooded the reactors. So the company basically went from almost zero to $40 million in the bank in the course of a year, and has become one of the most profitable venture-backed clean tech companies. And the reality is that the company did a fantastic job executing, and was the only American contractor in Japan. It was Areva, which many of you may have heard of, Toshiba, Hitachi, and rinky-dink venture-backed Irvine-based Curion. So that's one example of our approach to energy investing, taking a look at the overall space, seeing what areas are not, where a lot of attention and money is not going into, and trying to capitalize on those spaces. Another area that we're looking at is coal. So there's plenty of coal, as you know. There are uses for coal in the baseline energy generation space, but what about transportation fuels? There are very expensive, very capital-intense methods, one of which is called Fischer-Tropsch, to take coal and convert that to liquids. A great group out of a company called Cimix, which specializes in creating catalysts for non-traditional applications. We took that group we took a group of very talented chemists out of Cimix, and we built this company called Excelergy, which is now based in Houston. And they are developing processes for the direct liquefaction of coal. So you don't have to build a massive plant to take coal and turn it into transportation fuels. Another company, which I mentioned earlier that I'm on the board of, called Siluria. This is technology out of MIT, Angela Belcher, MacArthur genius. And she came up with a method for making catalysts that can do direct, basically the oxidative the oxidative coupling of methane (OCM) with a very small reactor. So again, you can take stranded sources of natural gas and turn that into ethylene, which can be converted easily to liquid fuels and chemicals. So those are the areas that we're looking at in the space, making better use of what we have, coal, natural gas, and turning into things that we otherwise have to take nasty things or do inefficient processes, for example, to be able to make the things that we want out of them.
Great.
And so that's just a few examples that we've done.
Yeah, no, well done. So I'm hearing let's avoid the herd mentality and be thoughtful about what areas may not be overinvested, overexplored. And I guess, Brian and Michael, help me out. Once Shaheen's found an interesting company that makes some sense and economic plan adds up, what's it like to raise capital? Maybe you guys could both comment a little bit from the early stage to, once you're in the commercialization stage to, give us a little bit of the lens for what's happening in public company land as well.
Sure. No, I'll go ahead. Generally speaking, public markets, from what we've seen, especially in Canada, and I'll let you speak a little bit more to the U.S. markets as well. You're not going to see a lot of interest from the public markets for the pre-revenue models. The high-growth pre-revenue models not getting a lot of interest. We're seeing a lot of interest for IPPs. Every investor in the world loves yield, if you can see that. But the stage of getting from that first, second round VC through to public markets, the one thing we're seeing more and more is, as we said, we're in a bit of a down cycle right now, and a lot of those third, fourth, fifth rounds are, a lot of supportive investments from the first and second round VCs, as opposed to new VCs coming in and spreading the wealth right now. So it's taking a lot of support for them to get to the public markets. And then once there, like I said, you've got to be beyond pre-revenue high growth if you want to capture interest. Another area of interest we're seeing a lot is environmental remediation. Outside of nuclear, we've got a lot of mining, a lot of oil and gas in Canada, and that takes a lot of cleanup as well.
Sure. Brian, you want to give us a little bit of commentary on the financing landscape here?
Sure. At Roth, we also would be, a boutique. We're a boutique, not a boutique, but a boutique, I would say. So we work with micro and small cap publicly traded companies. And in the world of clean tech, small cap by normal standards is $2 billion and below. By clean tech and our standards, it's small cap is $250 million and below, to be honest, and micro cap is $25 million and below. Is we see a lot of these companies in the clean tech world. So for those of you that listen to CNBC, like we do all day, everyone talks about right now we're in a risk-off environment. As we said, folks are looking for yield. So the Dow and S&P 500, if you look year over year, they're up 20%. If you look at clean tech as a broad industry, if you include solar in it, we're in negative territory for sure. There are some areas that are doing well, but in general, very difficult to raise money for micro, small cap, clean tech, publicly traded clean tech companies because of this risk aversion. And even those investors, the hedge funds that would normally do this type of investing, are sitting back on the sidelines a little bit here. So it really does have to be those companies. It's a real challenge for the pre-revenue, great idea, really large market. It is those companies that are actually making money as clean tech companies. So again, we're kind of at the opposite end of the spectrum from some of the VCs who are looking for dislocations and longer term thesis. In the public markets right now, everyone's, they can't see farther than, their hand in front of them next week. So everyone's very jitterish. They don't want to take any risk, not knowing what's going on in Europe, what's going to happen in Europe. China's growth is slowing. So the election. So a lot of uncertainty. So, we had a window. It's interesting. I say all that, and we've had Europe. Europe hasn't really changed that much. If you look back over the last year and a half, we're just regurgitating the same thing we did last summer. And the back half of last year for public company was brutal. No one was raising money, big, small, medium. We had the same thing happen again this year. But in March and April, there was this little window where the public markets opened up. And a lot of companies were able to raise money. We saw, again, over that same time period, we saw some biofuels companies, a splurge of biofuels companies go public, where I think a lot of people, it goes counter to everything I just said, right? Several of those are pre-revenue. Some aren't. Some are doing chemicals. Some are doing things related to foods enzymatically, which makes a lot of sense. But again, I think companies have to be opportunistic. There will be these windows of opportunity. So for public companies, what we tell them is you have to be prepared because you never know when that window opens. Be prepared to raise the capital when you can because you don't know how long it'll stay shut.
Have you been engaged with any of the big Asian investors, or maybe you could just comment, we've seen the Wenqing Group come in and buy 80+% of A123. Is this a one-off? Is this a trend? What are you seeing out there with Asian investors?
Me personally, Roth has a big platform in China. We've actually scaled it back a little bit. For those who follow the small cap publicly traded world, you'll know. Hopefully, those of you that invested early, got out early, because a lot of these Chinese companies that came over and listed on NASDAQ and New York Stock Exchange there's been a lot of scandal and controversy, and so they haven't done very well. Yeah, it's been a huge mess, a whole nother story. But so we have a strong footprint there, and so we still have folks on the ground, and we've really morphed that business from the public markets now to M&A.
Okay.
And yeah, we're seeing huge appetite from Hong Kong-based private equity groups, strategics, looking for big things, gasification, big things, biofuels, So yeah, I expect, and now we have companies coming to us who are struggling, saying, gee, can you go find some of these guys and bring them to us?
What should he do if that gentleman in the seventh row over there wants to get a big Chinese investor, other than hire you? What should he go to China? What kinds of things where does he need to be to make that a good fit?
That is tough. I don't. There's not a short answer to that one. Certainly, for folks who are active over there and know the landscape, you're at an advantage. I do believe, while it's not a one-off, it's timing, right place at the right time. A123 obviously extremely well known. There have been some smaller companies though, so it's the right place at the right time. But it is an extremely challenging place to do business.
Yeah.
You can think you have a deal done, you're at the goal line, and the rules change. So it is a bit of the Wild West. So I wouldn't necessarily encourage folks to be going over there, seeking that. But if there are opportunities, by all means, we can be helpful. There's others, but it is a tough place to do business still.
Yeah. Get your audience questions ready, please. We here at this panel care about engaging you guys. All 53% or 47% of you, depending, and 100%. Sorry. Thank you for that laugh. There was a little bit of a political gaffe that I was trying to add a little humor here. So I think Shaheen, I was reading about Siluria, and I think the last financing was co-led by Bright, which is a fabulous Russian investor, but most people have not heard of, and I think is it Paul Allen's group? These are not typical Sand Hill Road funds.
Right.
To poke a little bit. Tell us what happens. Do you just go up and down Sand Hill Road? No one wants to invest here, so you go to Russia? How does that work?
So, with the company being in the Bay Area, it was known, it was pretty much understood by the board, say, after the Series A, which happened, I think, in 2010, that, from here on, management was pretty much prepared to start going after strategic groups. So the Series B round, if I'm not mistaken, was led by the Wellcome Trust, which has a huge interest in making use of natural gas assets. So the Wellcome Trust is a UK-based foundation. So then, by the time the Series C came along, which is when Bright and Vulcan came in. Vulcan is Paul Allen's venture capital group. again, it was really all about the strategic value that Siluria can bring, and it was less about the kind of, looking for that sort of, Facebook-like return profile, which is really what a lot of Sandhill is going after. And just given the realities that were brought up this morning about companies requiring a ton of money and going nowhere, there's this general fear amongst the VC community putting money into these. Siluria pretty much was a science project. Putting money into a science project that would at the end go out and compete with billions of dollars of metal sunken into the ground, operating on 50-year-old technology.
Yeah, great. Michael, when you think about financing on the public markets, we've made a lot of noise around here around this Jobs Act, and I think it's kind of crowdfunding is going to be real, and we're just going to go put our business plan on CrowdRise or one of these things. Is that happening? Are people doing more crowdfunding? And also maybe you could comment on how does it impact the IPO process? I've read a bit about how you can do hidden S1s, but any comments on is it better, is it worse?
Well, the S1 isn't hidden. It remains a private document until its final stage. So there can be amendments to it that don't become public. But I haven't, and I'd love to hear your comment on this as well, but I haven't seen a lot of traction from it yet. And that may very well have to do with the types of companies we're dealing with and the stage of development that they're at. The IPO markets aren't gushing right now, so we're not seeing a lot of people use that or any other type of instrument or structure to go public. So I'm not seeing a lot of traction with it right now at all. I think it's going to be typically, as you were mentioning about the different market caps, I agree with you. It's the 250 million below is really more of the small cap that we look at traditionally, especially in CleanTech. But maybe as you move down, we'll see more of that.
Yeah, I would say we're in the early, very very early innings of the Jobs Act. I mean, some of the regulations are still being written. People are still trying to figure it out. But we're actively involved in one very large, confidentially filed S1 that will hopefully happen in the not too distant future, and one smaller. So the interesting thing is no one knows other than SEC how many there are, right? I mean, each bank is working on several, including the bulge brackets, and then we're working on some smaller. We're working on a very large one with bulge brackets. So I think there are a lot of them out there, and it'll be very interesting when the window opens back up, because a lot of them will be ready to go. They'll be teed up, and then will it be, there's too many, the system's clogged. It's going to be really interesting, because the longer we stay in this period of, a closed IPO window, unless you're the next Facebook, but even if you are the next Facebook, I don't know that you go public right now. Everybody's still a little burned and licking wounds, still figuring it out. Very traditional companies are going public right now. There's 7 on file for this week, and I was just looking at it, and it's financial companies and oil and gas companies. Yeah. I mean, traditional cash flowing businesses are looking to go public. So it'll be really wild when it happens, if it's another 6 months or a year, and you got all these backlogged IPOs sitting there just waiting for that window to open up. But I think it's a good tool. It really lets these companies, particularly some of the smaller ones, get through some potential issues in terms of going back and forth with the SEC, answering questions related to their financials, and testing the waters. The companies can go out, test the waters, and we don't have what we just had recently, which was 3 or 4 more biofuels IPOs pulled, which doesn't look good. So that's part of the logic behind doing it, I think, is you can do that privately and not get egg on your face as a company or as an industry.
Yeah. So forgive us if we didn't, maybe we should explain a little bit. In the old world, you file an S1 to go public and everybody can see it, and maybe you wish you hadn't shown your business to your competitors if you pull it. In the new world, this confidential filing means you can file it confidentially with the SEC. If you don't go forward, you don't have to show it to the world, which is different. If I go to the audience for questions, does somebody have a question for me right now? So please get them ready. I want to make this a conversation, so get thinking. But let's go to the M&A corporate world right now. And We have numbers that showed massive jump from 2010 to 2011, 41 billion in M&A activity in clean tech, but some of that was not venture backed. So maybe each of you could comment on what do you see with corporates, and be as specific as you can. Where are corporates really active? Shaheen?
So the sense that I'm getting from corporates is that they're looking to find deals where a lot of VC money has gone into what should have been done within their corporate R&D groups. So you see a lot of emphasis on technology, what's been proven. They want to have some kind of engagement. In some cases, they're even willing to invest in the companies with the expectation that they can get a first look on M&A events. But for us investors, that's not an ideal type of scenario, and that's not the scenario that we look to when we make these investments. The reality is that the M&A numbers, I don't have the numbers off the top of my head, but they're in the hundreds range in terms of average. And that's not the kind of profile that we're shooting for when we make these investments.
Yeah. Mike?
Not my area of direct expertise, but the one thing I will note is, and how it relates to the institutional investor as well, and a lot of the VC crossover funds a lot of the time, is that we're in a lower period where you see a lot of the valuations for these smaller companies at a spot where they're lower where they would be even if they were private, which has driven investors that traditionally venture capital to come into the public markets. And we're also seeing that drive a little bit of the corporates to look at M&A because things are just so cheap it makes sense.
Do you think part of that is driven by the compression of the valuations of those acquirers themselves?
I think a lot of it is, and a lot of it is the fact that you're looking at some of these companies in the clean tech space and the biotech space and other technology spaces where the money that they have raised and the cost to advance their pipeline of technology to where it is, it's cheaper to buy it than it is to do it yourself, to the tune of 50% sometimes.
Yeah. Brian, any trends?
Yeah, I would just say, I think the major trend over the last year and a half, and it's slowed down, I think, a little bit, is the smart grid. What do they call them? The four horsemen? The
Schneider.
ABB, Schneider Electric's just gobbling up these small technology companies to the point where, it's probably a lot cheaper to, they're happy to let them develop it and buy it once it's been proven, especially potentially with where some of the valuations are relative to where they used to be. We also see, so that's a big solar. I think there's a lot of consolidation going on. We continue to see the panel manufacturers buying installers, the downstream installers, because they need more panels. They need to sell more panels. So the first solar model of develop your own projects. Everyone else now is, others had slowly started, but I think pretty much everybody's doing that now. So whether it's being gobbled up by a big guy, or I think we'll see continued consolidation among smaller players in the solar installer world is one that comes to mind. And in the public markets, there are a lot of clean tech companies that don't like their valuations, probably should be taken private. But it's a real challenge when you get into valuation because they're at 52-week lows, and guys, whether it's a private equity group or a strategic, want to come in and pay a 25% premium over the stock price. And these clean tech companies see their stock down 50%, 80%, a 25%. They're looking for a dollar stock. They're looking to get paid $2.
Yeah.
So there's so many deals that make sense, but they're so difficult to get done for that reason.
Sounds like somebody can make money with that arbitrage. I don't know how. Let's take a question or two. I know somebody's got one out there. Is there a mic in the audience that can help us out? Yeah, I see a hand in the back. Please go ahead and please get a mic over there. Thank you.
Good morning. In our industry, we see a lot of companies start venture-backed and raise a lot of money, and now they're failing or even going under. From a venture capitalist perspective, what advice can you give to us entrepreneurs who see an opportunity to possibly even merge or acquire some of those technologies that really aren't making any traction in the industry but may be a complement to our business?
So just to understand correctly, the question is what technologies you should try to acquire
Or how?
Yeah, if there was a lot of money, you talked about R&D and M&A, Schneider's out there, or was out there buying up some of these technologies, once they're proven. In our industry, we're in the energy efficiency space, and there are some companies that they compete in our area, but they're failing. They may have 50 million plus venture-backed dollars, but they're not making any traction.
Yeah.
So, obviously as an investor, you only put so much in. From someone like ourselves who are doing well, how do what do you recommend being an investor if that was your portfolio product that wasn't taking any traction? How do you go about taking something like that and turning it into something?
Great question. Shane, you want to start?
Yeah, so I can tell you right now, for example, with Curion, we've taken a very aggressive M&A strategy. We've already acquired one company to expand our market. So if you have cash in the bank and there are interesting companies out there with some real market traction, with real feedback from customers, and given the fact that you're in this business and you can, with a high level of certainty, assess how much money is needed to turn these businesses around from loss generating to profit making, and perhaps even leveraging some of the resources that you have in-house, so you would be uniquely able to do that, then I would be very supportive of that. I think talking to guys like this on the panel in terms of putting you in touch with these companies, there's a lot of great bankers out there who have a lot of visibility to companies with great assets. And also, of course, there's the universities, but then the problem with the universities is that there isn't going to be probably as much market validation as there would be at the companies. So my advice would be a lot of emphasis on market validation, a lot of emphasis on getting comfortable with how much money that cash will have to go into these businesses from your balance sheet to turn them around, and going out and finding the right bankers who have visibility to these companies.
Yeah, I think, Brian, please continue.
Yeah, I would say, I live this every day as a banker, talking to lots of small companies, both public and private, and it's tough for me. I'm on the outside. I'm not the entrepreneur whose blood, sweat, tears, sometimes, a lot of times their equity, houses, mortgage, the full gamut of things that are involved, 5-10 years. It's easy for me to come from the outside and say, look, if you want to go out and raise money, it's all about scale right now. You're doing $3 million in revenue. It's hard to get someone's attention when you're doing that. Let's look at you and this company, and all of a sudden we've got a 15 or a 20 million, so it all boils down, unfortunately, to a lot of these cases, egos and valuation, and ultimately deals don't get done, and that's why. I think consolidation in whether it's energy efficiency space needs to happen with a lot of smaller companies, solar for sure with a lot of these small companies. A lot of, when people see huge opportunities, a lot of very, and I give them all the credit in the world, smart, taking a lot of risk, entrepreneurs jump in. Yeah. And it's tough to jump out or to try to team up with someone else and again try to get to scale to get folks' attention.
Yeah, I think it's a fabulous question, because I think we spent a lot of our time focusing on Schneider. Buying 12 companies last year, and GE and so on. But I think the upside of tougher fundraising conditions is there are a lot of assets that are can be bought. And if you are operating a business that's going well, you've got a real opportunity to go, beef up your product portfolio. Absolutely. So we haven't talked a lot about government programs, and clearly they've shifted a lot in this space. Michael, maybe you could kick us off to say, as you think about investor relations, does that come up a lot? Where's the government support? Is this, this subsidy word, and what's your take on? Is this a minor political shift in our space?
It's not. To be honest, for me, it's not something that comes up a lot. I hear it mentioned, but it's not something that in the investor relations space we deal with very often. I do know that when they're worried about, are we going to get support, it's more often being asked about that from the venture capitalists and institutional public investors. So I'll let the other guys take this one a little bit more than me.
Shaheen, there's a lot of talk about things like production tax credit and you know, what's your take on government programs globally here?
I think government programs are great. As VCs, it's very difficult for us to plan based on them. So we typically, we hope for them, but we don't bake them into our assumptions when we're making investment decisions. We like it when our CEOs go out there and try to find grants and partnership programs with the government to be able to, you know, find non-dilutive sources of capital. But again, it's not something that we count on. And in fact, for every dollar or every $3, I think that we've invested in our companies, we've been able to bring on about $1 in non-dilutive money from the government. So again, great resource, but it's icing on the cake for us.
Yeah. Brian, are you watching kind of which feed-in tariffs are getting cut and which city programs are launching, or what's your?
Well, not really. I mean, they're obviously very important to solar, wind, but to be honest, you know, I got into CleanTech over 7 years ago, and it seemed almost within the first year or two, every investor meeting you went to with a company was, well, we're not interested in if it's dependent on government subsidies, right? Business model can't be dependent on government subsidies. So it's something we've been hearing for years and years and years. As Shaheen said, if it's there and you're able to take advantage of it, and it's a 5-year window, or you know there's some stability there, then certainly that makes sense. I mean, yeah, we're not out raising money for a lot of solar companies right now. Why? Because it's volatile, and you've got all this overhang from the different government subsidies and the volatility and the pricing. So, yeah, you're really hopefully finding those companies that aren't dependent. That's why folks are moving to energy efficiency, right? You don't need it. I mean, that's why there's been a boom in energy efficiency. So yeah, I think again the market evolves, and when there's a subsidy that has a lot of, you know, people believe in it and it's going to be there for a long time, then people will be to raise money around it. Otherwise, it's a challenge.
Yeah. Let's go back to the audience. Who's got another question for me? In the back, please get a mic to.
Which clean tech sector or sectors do you think are poised for the biggest growth in the next 1 to 5 years?
All right. Shaheen, kick us off. Which sectors?
As was mentioned earlier in the panel, I think it's energy efficiency, making use of what we've got. We haven't made an investment yet, but I'm looking very closely at the unconventional oil space, tertiary.
And let me
oil
interrupt, forgive me. Within efficiency, which areas do you like? Do you like residential, industrial, commercial, or some part of that? What's intriguing to you?
So 2 months ago, we invested in a company called Gridco, which is making solid-state routers of power on the grid. So think of them as a Cisco for the grid. And the founders of this company are people who founded Sycamore Networks and Juniper. And we brought together a great group of power engineers and IT people, and they're using silicon carbide-based power electronics to make these solid-state equivalents to 100-year-old transformer technology that we have right now on the grid, which is leading to a lot of the blackouts and the inefficiencies and unreliabilities that we have on the grid. So to answer your question, yes, energy efficiency is a big one. And making the most of the resources that we have has been a recurring theme for us at Lux, if that answers your question.
Yeah, it sure does. I think Michael, maybe he was about to go on the unconventionals. Maybe you could either of you guys could comment on it. Feels like a boom for certain clean tech companies where you have, incredible amounts of water being used to explore for oil and natural gas. Canadian oil sands being a big area of growth here. What are you guys seeing in this area?
Again, for me, as I mentioned earlier, I think environmental remediation is going to be very big over the next 5 years. And I think we're seeing in the Canadian space, and I think we're starting to see a bit of pickup in the United States as well, is services to the IPPs as they grow and begin to provide yield, and they're going to need more and more services for their operations on a day-to-day basis. I think those are the two hot markets we're going to see as well.
Yeah, I would say more broadly than energy efficiency, just call it demand-side management, anything related to that. Natural gas, we put it within clean tech. I think most of the folks do. It's that cleaner alternative to oil, to diesel and bunker fuel and other oil that's used. Massive opportunity, obviously. I mean, you can't pick up the paper without reading about natural gas, and we have a couple companies here locally that are heavily involved in that space. So a lot of opportunities there. It is a little, more capital intensive depending on how you go about it, how you enter, than say the energy efficiency space. Demand side management is great because it's capital light. It can be a couple of people and a computer coming up with some novel ideas on energy management. And within that, I certainly, commercial is the largest opportunity. I think industrial, much like everyone talks about the smart grid, everybody thinks of the smart meter that's put on your house. Well, utilities are actually spending more money, and the bigger opportunity is way beyond that. It's all the other aspects of the grid that they're going to be upgrading. I think it's similar with industrial.
Yep.
With manufacturing, I think there's a lot of interesting opportunities about upgrading and manufacturing. We're going to see a lot of manufacturing, and we've already seen it starting to come back to the U.S. from China as their wages start to go up over there. So that's, again, natural gas is a key one, but again, probably a little more difficult to enter than some of these others. And solar, I don't want to lose sight that still massive opportunities in solar. Actually, we're still very focused on it, even though I said it's hard to go out and raise money for the companies. But when you just look at the dynamics with solar and grid parity, as the cost of the panels continue to come down and the cost of balance of systems and installation, every year millions of homes are being put into that space that all of a sudden it makes sense to go to this state now and start offering solar. So huge opportunities for for the next 20 years, I believe, in solar. And a lot of those are actually on the residential side as opposed to the utility. That will be the domain of probably some very large players who operate in the utility, but on the residential side, still lots of opportunities there. And that will segue over time. We see Solar City do it. We've seen some others of trying to do energy efficiency at the home level. All these meters, these little devices you put in the home and try to monitor, that hasn't gone very well. But I think over time that will evolve as well.
But in case you're new to the space and you've heard only the negativity around solar, I think companies like Solar City, Sungevity, Sun Power, Clean Power Finance, these companies are growing like gangbusters with their downstream.
Yeah, I would say if you're really good at finance, there's a massive opportunity to get involved in financing of solar.
Yeah.
Whether it's large scale, it's not a simple process, but once you get to know the players, if I had a nickel for every time a solar company came to me and said, I've got a great project, I just have to figure out how to finance it. And they can get done, but it's a full-time job, so it's not something I'm able to focus on full-time, but massive opportunity long-term as we move from something that's a very niche-y product to 10 or 20 years from now, it'll be like getting an auto loan.
Yeah.
It'll be that easy to finance solar for your roof. It's easier now, but it'll get even easier.
But let's shift gears and talk a little bit about companies in the space and young companies. And Shaheen, put you on the spot a little bit. Tell us about talent. When you meet with CEOs in the space, are you seeing great CEOs and great talent? And also, when you look at your portfolio companies trying to recruit sales, marketing, engineers, what's it like?
I think there is fantastic talent out there, and the challenge that we have right now is that there are so many great people that we need to keep at our companies. And there's a lot of people trying to poach that talent, both from large companies and other startup companies. So I say there's great talent out there. It's a matter of making sure you're putting that talent to work properly and keeping everybody motivated and incented.
Michael, you work in the investor communication, so give companies at all stages a little bit of advice. What do companies that do it really well do? And I'm sure you've seen a couple companies that don't do investor relations well. And just to clarify, are you working with folks who are public on the TSX or not necessarily just on the TSX?
We work with, we have about 120 clients. I'd say close to 100 of them are public. Of those that are public, some are dual listed, US and Canada, some are just Canadian, some are just US. So really across the board on that. With regards to the advice I'd have for a company that comes to me is first and foremost, know what you don't know, and don't be ashamed of that. That's the smartest people in the world are the ones that know what they don't know, and then go find the help to fill that gap. And a lot of the times you're going to get it from your VC investors. These are guys that, generally speaking, have a very broad background from operations to M&A to financing. And those are the things that we find most of the, there is great talent out there, but a lot of the times it's technology-based talent. It is building a widget or creating the next perfect wind turbine or whatever it may be. But the marketing, that's the one thing that I think CleanTech is coming to grips with now, is that CleanTech is not just tech. It's an industrial to a large degree. I'd argue that Tesla is more GM than it is Google, and A123 is more manufacturing like Duracell than it is like Facebook. So you've got to come to grips with what you know to be able to build and get to those companies that are now manufacturing and marketing and selling. So know what you don't know and find the people to help you get there.
Yeah. Brian, same kind of question around the M&A process. If we perhaps have a woman, I have no idea, who's thinking about selling her business there, how do you know if this is the right time? And then if we do engage in a process, what are the gotchas that you've seen that really trip a company up, and or the flip side of what makes a good M&A process?
Interesting. Again, it's all about opportunity, and I think, to be honest, most of the M&A I deal with is not the 900-pound gorilla swallowing the minnow, or someone much smaller. That tends to be, pretty simple in the long run. Ultimately, the 900-pound gorilla probably has the cash or the wherewithal to get it done. It might be a painful, long process of negotiation, but ultimately you get there. The world where I work in, and I think most of the companies here are much smaller, and that's where it is much more challenging. And not to restate some of the things I've already talked about, but it ultimately ends up being, more companies at about the same size and valuation. So ultimately, it boils down to penny wise, pound foolish, right? I mean, it's always my advice, our advice is, do you want a bigger piece of a much smaller pie, or do you want a smaller piece of a much bigger pie? And in most instances, teaming up, joining forces with, again, companies that generally are similar in size, or one is slightly larger, ultimately that growth will be faster, and you will see, I believe, more upside. But those deals are tough to get done.
Yeah. Let's take a couple more questions. Who's got one for us here? I know there's one right there. Sir, yeah, please.
Good morning. I'm Mike Reagan from a company called Millen Works. Curious where you guys, where you think in the automotive sector. Michael, you mentioned Tesla and A123. Tesla, their Model S looks like could be very promising. Coda's doing poorly. Fisker has got its own challenges. Just like to hear what you guys are thinking in the auto sector.
All right.
I'm happy.
Go for it.
I spend a lot of time, and when we talked about growth sectors earlier, I'd love to say hybrid electric vehicle. I'll certainly say natural gas vehicles. Massive opportunity going forward, and for the next 10 years probably. I think we've all been through the early stages now with the Leaf out last year, and we're seeing, Mitsubishi and Ford will be coming out with an all-electric. We've got a bunch of hybrids. I think everyone's expectations were a little, I'm sure you guys had some of your own, internal thoughts on that, and the VC. So everyone, for the most part, everyone missed it. Expectations were set too high, and I think it was unfair that everyone set those expectations so high, because when you really look at it, it's going to be slow growth. 20 years from now, I have no doubt in my mind that my kids are going to be driving around in electric vehicles. I think it's got to happen. The distribution network is everywhere. But it happened a little too soon, too fast. So we're really still in the pilot phase of this. GM's getting beat up. Someone comes out with a report, they're losing $60,000 on every vehicle. That's crazy. That's going to be amortized over the Volt sales over the next 10 years. So I think, I talked to lots of small EV companies. We've seen, like you said, there's a number, Azure Dynamics, Innova, the public ones that have gone under or close to it, some of those others on the road. So it's very challenging for small companies because there's no one making really big orders. Everyone keeps waiting for UPS, FedEx, the big commercial users to order in the thousands and thousands of units, and it's just not happening yet. And for those involved in it, I think we all know the reason. Batteries are still expensive. That price has to come down. I think it will happen. So there's a huge opportunity still in the battery space. It's just that's been happening much slower than everyone anticipated as well. There's been no big jumps. It's been incremental with lithium ion. So
yeah, Michael?
I think there's big opportunities, but it's going to take a while.
Yeah. Any other comments on transportation?
You led in well to what I was going to say is two things. One, I think there's technologies within that car itself that need to come up to speed, mainly the battery, I think, and that's going to advance the industry tremendously. But I think what we've seen for that we think will grow a little faster is not just the Fiskars, but those service providers that are building components for those vehicles as well. There's some great CleanTech transmission companies that are coming up with some new and innovative ways that are going to create a better transmission for a car. So things like that and the batteries, I think, are what are going to be the component pieces that really drive a lot in the automotive industry. But again, it's not just having a great technology, it's finding out what you don't know, whether it's the marketing, putting together the infrastructure like Fisker or Tesla, selling, all of a sudden having dealerships, they don't just pop up around the country. You've got to know how to put them there and how to do that marketing. And I think that's going to be, that's the same thing for the components of those vehicles as well, is finding out, bringing somebody on board or working with the right VCs that have the relationships with the auto dealerships and the automotive companies that are really going to drive those business.
Yeah. Shaheen, let's bring you in. Get any other thoughts on transportation? Maybe I can egg you on and see if will you debate him a little bit on natural gas? Natural gas for transport, silly idea.
Taking a step back, so long as the public, the consumer market, sees value in green, environmentally conscious, behavior, product choices, I think there's always going to be a place for EVs, hybrids, maybe natural gas, cars that fulfill that image or that desire of the consumer. The reality is that at a broad scale, at least I haven't seen the market pay more and get less, or in the EV case, significantly less. You pay $120,000 for a Fisker, which from a feature standpoint is probably a 5 Series BMW that costs a third as much. So I have a hard time envisioning electric vehicles, hybrids, ever getting to the mass scale, meaning that, let's say, 6 in every 10 cars is one of those cars, until battery technology, charging technology, all of these things significantly come down in cost, such that a alternative fuel car, natural gas, how you store the natural gas, you have to carry a 200-kilo tank in the back of the car. Once these technologies evolve to the point where one of those alternative fuel cars behaves and feels and performs and costs just as much as the regular car, then you'll have some real traction. Otherwise, we will continue to have EVs the same way we have convertibles, we have monster SUVs, we have, the chrome painted cars, that meet certain consumer tastes. These cars will also meet consumer tastes, but in a limited fashion.
What makes you bullish on natural gas and vehicles? I mean, I know there's a retrofit fleet here, but there's no infrastructure.
Yeah, again, it's over longer scales, but when you see, I mean, you could use the argument against me on EVs, right? In case I'm going to say when GM and Ford are announcing a natural gas pickup truck, that's their largest selling vehicles, there's something to it. I do believe this natural gas highway for the big rigs, there seems to be, regardless of which side of the political aisle you're on now, there'll be support for natural gas. I think some infrastructure to use all the natural gas we have. So whether it is a sprint for 5 years and then it goes away, I'm not sure. But for the near term, there'll be huge opportunities around natural gas, I believe, in transportation. Again, relative to electric vehicles for the reasons I think we all know. It's going to be measured on decades for EVs, pure EVs. Hybrids have a much stronger case. I mean, we don't even use stop-start yet in the U.S., and they've been doing it in Europe, and it's the simplest thing to put on your vehicle. So incremental technology improvements, move to hybrids, plug-in hybrids, longer-term EVs.
In fact, just one comment. So Top Gear, for example, did a comparison of a 3-cylinder Kia that's not even available here in the U.S. Maybe not. I don't know. Back then it wasn't. And they compared it head-to-head with the Prius. The Prius got worse gas mileage. It cost more. It was a smaller car. And it was just a significantly inferior car. However, it was a hybrid. And you see the Prius being selling like gangbusters here in the U.S. and Kia not even offering that car here. So it's the fact that soccer mom doesn't want to be seen driving that little Kia Econobox that's probably maybe putting out blue smoke, maybe not 3-cylinder diesel, and would prefer to be in the hybrid. So a lot of it is also consumer demand and kind of mindset and marketing as well.
Yeah, I think just one quick thing. I think it's great for the industry. The rising of the pushing up of the MP miles per gallon standards. I mean, it's incredible when you listen to the radio these days. It's a battle over MPGs, right? And it makes it tough on the hybrids because they're always a little behind in terms of the engine, the internal combustion engine they're using. They're using older technology, and you have Hyundai and these other folks talking about 45 miles per gallon from a normal internal combustion engine. It's tough to compete when your hybrid you're getting 55, but you got to pay an extra $5,000 for it. So it's very interesting. But I mean, it's been great for fuel economy.
What about resource sharing? We all put our cars on get around or relay rides. Is that going to be the game changer to transport and other sectors? This kind of collaborative models. Shaheen, you're skeptical.
Maybe in Europe, but in America, we love our cars. I have a hard. Maybe in very, very dense urban areas, I think it's a great idea. I think Zipcar is doing very well in San Francisco, but
anybody use Zipcar or Get Around or Relay Rides to get here?
No, not today. I've used Zipcar.
All right.
Yeah, I mean, it's big in New York.
Jeff, get a mic over here, please. I've put my car on Get Around, my
Good morning. My name is Shaw Ali. I'm from CleanTech Fund, based here in California. I have two questions, but I'll ask one at a time. First, the one relevant to the question that was just posed. Regarding natural gas, I'm kind of curious why the build-out of infrastructure hasn't happened yet. I've been to countries, emerging, developing countries, who have built out infrastructure within years, in less than a decade. And it generated a lot of jobs for conversions and for small businesses to start up CNG stations. I don't understand why that's not happening here, why there is an inertia to doing it. And given what T. Boone Pickens talks about natural gas being the next driver, I'd like the panel to comment on why there is a resistance to build out the infrastructure for this country.
First of all, I think the gentleman might be able to help us if we don't know. Do you know which countries are leaders in natural gas vehicles? Anybody?
I mean, A lot of countries in South America use a lot of natural gas. In Asia,
I think
use a lot of natural gas. India, a lot of these countries are they're way ahead of us on the natural gas front. I mean, for the simple answer would be the volatility in natural gas prices, right? We're just at the beginning of this whole fracking. I mean, if you look 50 years to the future and you look back, okay, but we're really only 5-6 years in to this fracking. It's really just turned the whole natural gas world upside down. So I think people are still trying to get their arms around it. It's starting to happen. In this society, things don't happen overnight, for sure. It's a lot harder to get things done, kind of at the government level.
On UPS, though, I mean, there's a lot of CNG fueled fleets, though, correct? And a lot of the, I know in Santa Monica, all the buses are CNG.
Right.
And I think UPS.
They had historically, and then the price went to 13, and nobody did it
Came out of
anymore.
favor, and the government policies shifted.
So hopefully, people will agree that we can be on a 20, 30-year trajectory here where natural gas stays between $3 and $5 and doesn't go back to 15. If we have that, then I think a lot of decisions can be made at the government at higher levels to support that build out, as well as by the Chesapeakes and the Exxons and the folks in that business. They're not producing right now. They're removing drills. They're moving drills from the natural gas sites to oil sites because they make a heck of a lot more money drilling for oil than natural gas right now. So until we start exporting it, which will happen, I think, in the next few years.
All right, I think I see a stop sign. Let's take the last question. If you still have the mic, feel free to use it. Did you have a second question, sir? Or,
yes.
Go ahead.
It seems to me, again, coming back to natural gas, do you think that the momentum in clean tech is a victim of the embarrassment of riches we have in natural gas? And are we losing sight of opportunities elsewhere besides the United States to exploit clean tech technologies, maybe in Africa or emerging countries?
So let's end with where outside of the world we should be looking, for the next wave of interest. Is it Africa? Is it the Middle East? Is it China, Russia? What maybe each of you pick a region and explain what's of interest there, and then we'll wrap there.
I like to use the analogy of cell phones. So, for example, Africa, a lot of places, I guess, in the underdeveloped world, there wasn't a whole lot of infrastructure for telecom, but then they went straight to cell phones. Yeah. We're seeing a lot of one of my colleagues keeps on using the term Africa solar or something, meaning that a lot of areas that probably didn't have power will have power because of the availability of cheap solar modules. So they go straight to renewable versus going from dirty to renewable the way the developed world has.
So if you each have to pick a country or a region, which one would you pick? Would you pick Africa? Is that right?
Based on my colleague's comments, or
all right.
Phrase, yes.
Good. Michael and Brian.
Well, I'm based in San Diego, working with TMX Epicom, part of the TSX, But on behalf of where I'm from and the TSX, I'm going to pick Canada. And the reason I do is I think, as there's ebbs and flows with how fast the world's growing. China is growing fast and slowing down. India, the same. But as any of these areas grow, and as they do continue to grow, they need, and I agree with your comments on, kind of skipping the dirty a little bit. But they're going to need materials to grow, and there's a lot of great companies in Canada that are producing power and that are mining clean materials that are going to be helping to industrialize the world. I think it's a great spot to look.
I'll keep it short. I mean, I'd love the Africa play long term, but I have to stick with India and China, and it's hard to bet against the growth there. So.
I'm going to take moderator's prerogative to pick Brazil, and come chat if you want to hear why, but join me in thanking this great panel for a terrific conversation.
Thank you, Gerald.
Okay, we're going to take a break in a moment. I'm going to also do chair's prerogative to make a comment and tease a couple of panels this afternoon. There was a question from the audience, what area do we think there's going to be the greatest growth and opportunity? And two that we didn't mention were water technology, and that's the panel we're going to have right after our break now, and I think it's got the very narrow title of The Future of Water. I think you'll find that panel interesting. And we touched a little bit on smart grid, but I think we kind of focused a little bit more on the end user end. I think there's some tremendous growth and opportunity at the utility side of the smart grid scale, and we're talking about wireless communication and information technology for utilities related to smart grid, and that's the panel after lunch. So we're going to take a break of about 10 or 15 minutes. So hopefully you'll get a chance to visit the exhibit hall, and then we'll be right back here at 11 o'clock for the water panel. Thank you again.